Welcome to this explainer. I'm so glad you're here because today we're doing something a little bit different. Think of this session as your personal masterclass and, well, I'll be your mentor. Look, if you've been feeling totally overwhelmed by that endless stream of market noise, the flashing indicators, those chaotic news feeds, it is time to strip all of that away. Today, we're getting back to the absolute core of how markets actually move, and we're doing it by focusing purely on price action. We're going to learn how to read a naked chart exactly like a seasoned pro.
Okay, let's dive right into this. Niall Fuller, who's a highly respected professional trader, hits the nail on the head when he says support and resistance levels are a price action trader's best friend. Seriously, if you want to stop bleeding money by trying to guess how the market's going to react to some random news event, you've got to master these invisible barriers on your chart first. They are literally the absolute bedrock of profitable trading. Without them, you're just guessing in the dark. But with them, you've got a structural map of the entire market's psychology.
So here's our game plan for today. First, the foundation of price action. Second, navigating ranges and trends. Third, trading the price action signals. And finally, number 4, the master secret of confluence.
All right, let's kick things off from section 1, the foundation of price action, the foundation of trading.
You can really think of support and resistance levels as the floors and ceilings of a building. It's like a rubber ball bouncing around in a room. Whenever the market reverses, it leaves behind a peak at the ceiling or a trough down at the floor. That's what we call a clear swing point. So by connecting these bar highs to other highs or lows to other lows, we create horizontal lines on our charts. And listen, these aren't just random arbitrary lines. They are the actual physical footprints of where buyers and sellers battled it out in the past, and where the balance of power actually shifted.
Now, when you've got these parallel support and resistance barriers, they carve out what we call trading ranges. Inside one of these ranges, the price will bounce or oscillate back and forth between that support floor and the resistance ceiling. The key takeaway here is that price will repeatedly respect these containment barriers. It's going to keep testing the floor and bouncing right back up to the ceiling until eventually the pressure builds up so much that it just has to break out. And once price finally breaks through, boom, the entire dynamic of that market totally changes.
Moving right along to Section 2, Navigating Ranges and Trends, Market Navigation.
So, let's see how this builds when a market is actually trending, because these levels act a little bit differently here. In an uptrend, price breaks up past old peaks, those previous resistance ceilings. But as the market naturally pulls back or retraces, those old ceilings actually transform into brand new support floors. And in a downtrend, well, it's the exact opposite. Old support troughs get broken, and when price retraces back up, they act as new resistance ceilings. A seasoned pro isn't out there wildly chasing the market, no way. They're looking for an entry exactly when the price retraces to test those previous swing points. That right there is where the trend is most likely to resume, giving you a brilliantly low-risk, high-reward entry point.
Now, what's absolutely fascinating is this concept of the flip. See, a true key level has an incredibly long memory in the market. A specific price point might act as a tough resistance ceiling during a downtrend. But once that resistance is finally smashed and a new uptrend forms, that exact same level can flip and act as a major support floor months later. It's wild. The market remembers these zones long after the macro trend has completely shifted.
Okay, let's open up the Sniper's Toolkit in Section 3, Trading the Price Action Signals, Spotting Entries.
Look, you do not need 100 different flashy indicators on your screen. You really just need to recognize a few powerful footprints. The main price action entry signals include the pin bar pattern, which essentially shows a sharp, immediate rejection of a level. Then you've got the Fakey, which is a false breakout that mercilessly traps all those amateur traders who chase the wrong direction. We also have the standard inside bar pattern and the highly potent pin bar and inside bar combo. Think of these specific candlestick signals as the definitive visual confirmation you need to prove a key level is actually holding strong.
Now at this point, you might be getting a little excited. You're probably going to pull up a chart and start seeing pin bars and inside bars absolutely everywhere. Which brings us to a super critical question, one that traps almost every single beginner. But should you trade every single signal you see on the chart?
The answer is a definitive, absolute no. You should only trade these signals when they form at key levels of support or resistance. So the crucial point is this. A pin bar just floating out there in the middle of nowhere, it's practically meaningless. It is the structure behind the signal that protects your capital. A key level gives you a literal physical barrier to safely tuck your stop loss behind. And because that level has a really strong chance of being a major turning point, taking the trade there naturally creates a fantastic high probability risk-reward scenario. The signal? That's just the trigger. The level itself is the actual weapon.
And that brings us to the grand finale, Section 4, the master secret of confluence.
the ultimate setup.
Before I reveal the big secret here, I want to hand you a few veteran pro tips straight from Niall Fuller's playbook. First up, don't go crazy trying to draw every little micro level on your charts. Just stick to the obvious, key daily chart levels. Second, remember that this is an art, not an exact science. We're not painting the Mona Lisa here. Your horizontal lines aren't always going to perfectly touch the exact high or low of every single bar. Sometimes it connects slightly down from the high, and you know what? That's totally fine. Finally, the golden rule. When you're in doubt about a signal, if it's not at a key level, just pass on it. Charting isn't about rigid perfection. It's about finding the most obvious zones and having the patience to wait for them.
And this brilliantly illustrates our master concept, market confluence. Simply put, a price action strategy has a significantly better chance of actually working out if it forms from a confluent level. Confluence is just a fancy word for a high probability setup that happens when multiple factors, like a key horizontal level, the overarching trend direction, and a specific candlestick signal, all align perfectly right at the same spot on your chart. When you stack these factors together, you are essentially removing the guesswork completely.
So here is your actionable confluence checklist. Whenever you sit down to trade, I want you to follow these 3 steps with absolute, unwavering discipline. Step 1, identify your key daily support or resistance levels. Step 2, observe the context. Ask yourself, is the market in a trading range, an uptrend, or a downtrend? And step 3, do absolutely nothing until a clear price action signal, like a Fakey or a pin bar, forms at that exact key level in the direction of the market context. Honestly, true professional trading is nothing more than a highly disciplined waiting game for these 3 exact steps to align.
Which leaves us with one final thought to close out today's masterclass. Now that you understand the true mechanics of support and resistance, the patience required for clear signals, and the incredible, undeniable power of confluence, are you going to keep losing capital by trading that unpredictable daily noise? Or are you finally ready to be the sniper, wait patiently, and let the market come to your key levels? The choice is entirely yours. Thanks so much for joining me for this explainer, and